One of my really guilty pleasures is I like checking my mortgage every month when I pay my principal down and I'm that much closer to paying it off. So mortgage rates, however, have spiked recently. We're now seeing average rates at about 5.25%, which is much higher than the sub 4% rate we've come accustomed to the past basically decade or so. And so what does this mean? How do you plan for this? So on and so forth. So first, let's keep it into perspective. Over the past 40 years, maybe you're just new to buying homes, but over the past 40 years, we've seen mortgage rates go anywhere from 16% to 3%. And I'm talking about fixed 30-year rates here. So that's a big swing. And as a matter of fact, if you average out what the average interest rate on a mortgage has been over that time period, it's a tick under 8%. So one, keep in perspective, 5.25% rate is still not historically terrible. It's actually quite decent. Now, of course, I know what's happening in the markets, and it makes us panic as to, is this in unsustainable rates? Well, the answer is no. The markets will rebound. So let's talk predictions. So analysts are saying anywhere between 5.25% to 5.75% by year end. I think you may want to prepare yourself for 6 to 6.5% rate by year end, especially with the Fed talking about multiple half-point raises coming up in their overnight lending. So I think somewhere in that range is a feasible place to look at for year end. So now it poses the question, what does this mean? What does it mean for the real estate market, and what can you do about it? So the real estate market, one would think that the buyer pool shrinks a little bit. You put up your house for $1 million 6 months ago. Well, it's going to cost a lot less to buy that home than it is today. So you would think the average time to sell a house, housing prices may get crunched a little. I don't see it being a big explosion and blowing up housing prices, but they could soften. And like I said, there may not be 50 buyers for every seller where you're getting cash offers over ask at day one. So that's one thing. Now, two things to consider. One is that I do believe the buyers will be somewhat resilient. There is wage growth all over the place. Unemployment is still at record lows. And I think you have people who have been bottled up living with their parents or siblings for a long time that will kind of do whatever it takes to get out. So I think that'll help combat the increased rates. One trick I can suggest is when you go to get that mortgage is maybe look at a 5-1, 7-1, 10-1 ARM. So it's a way that you can get a better than market rate on a 30-year fix, but it's only fixed for 5, 7, 10 type years. And then at that point, it amortizes to a 30-year loan at whatever the current rates are. But if you're not going to be in this house for a decade or more, it may be a risk worth taking, but consult with your financial planner or your mortgage expert to help really analyze what this looks like. But in any event, mortgage rates are on the rise. Prepare for it, ready yourself for it, and know what it means for you and your situation. As always, I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy.